On May 19th, 2005, Michael Burry bought his first credit default swaps in anticipation of the housing crisis. 60 million of credit default swaps from Deutsche Bank, 10 million each on 6 different bonds. His prediction? The US mortgage-backed security, once a stable, respectable investment product, had slowly turned into a dangerous and deceptive time bomb, all caused by greed and corruption. In his eyes, this bet was no gamble. He did the digging, he read the documents, he knew what the outcome would be. His problem was that it would take the rest of the world another 2 years to even start looking. It took until the 11th of October 2007 for the S&P 500 to top out at 1,576 points. A year and a half later, on the 10th of March 2009, the S&P closed at just 676 points, a 57% crash. Michael Burry ended up making a personal profit of $100 million and made his investors over $700 million from this single bet. But in the years leading up to this amazing success, he received constant criticism from the investing world and even his own investors. Criticism that ultimately led him to close his fund after all had been said and done. But why am I telling you about this now? This happened 15 years ago. Well, you guessed it. History is currently repeating itself.
The first one to see that something was seriously amiss in the burgeoning subprime mortgage market was Dr. Michael Burry.
I could see the credit standards within these pools deteriorating.
So you made a ton of money.
I was extremely confident in the outcome.
Were your investors as confident?
It's remarkable. There are investors who made tens of millions off this and we're still pretty upset.
It was back in February of last year that Michael Burry first warned of high inflation as a consequence of the Fed's unprecedented money printing. He was tweeting to prepare for inflation, hashtagging doomed to repeat, and calling out the US government and the Federal Reserve over the trillions of dollars worth of stimulus they'd done. And at this point, he was the contrarian. At the time, all looked well. You know, the Fed was printing money, yes, but inflation was staying low. At the time, the latest published data showed an annual inflation rate of just 1.7%. That's lower than the Fed's target. But in classic Burry fashion, he was just early. Fast forward 12 months and we're now running at a red hot inflation rate of 8.6%. Habitually be 1 to 2 years early on literally everything and you too can attain broken clock status, Burry tweeted a month ago. Of course referencing a tweet made by Elon Musk where he labeled Burry as a broken clock. But what's very interesting is that in the past month or so, Michael Burry hasn't just been doing victory laps. Instead, he's been tweeting quite extensively explaining why he believes this economic crisis and subsequent market downturn has only just begun. Now, I certainly don't like to be a big doomsday predictor on the channel, so please don't take this video as me fear-mongering. However, I do want to at least cover Michael Burry's full rationale to begin to understand what he's thinking. And yes, the overarching message is he believes the worst is yet to come. So much so, he thinks the S&P 500 could lose another 50% from where it sits today. On May the 3rd, Burry tweeted regarding paradigm shifts and speculative peaks, the S&P 500 bottomed 13% lower than 2002's bottom in 2009, 17% lower than 1998's LTCM crisis low in 2002, and 10% lower than the 1970s low in 1975. 15% lower than the COVID low is an S&P 500 value of 1,862, roughly Shiller PE of 16, nominal PE of 9 in historic range. I'm not gonna lie, I had to read that one quite a few times to actually get that phrasing, but what he's noting is the trend we've seen over the past 25 years is the bottom of a current market crash is usually lower than the one that came before it by about 10 to 15%, adding that 15% below the S&P 500 low that we saw in 2020 takes us down to 1,862 points. That's crazy because it shows that Michael Burry is anticipating a peak to trough fall of 61.4%, which would bring us back down to the historical normal Shiller PE of roughly 16. Essentially, from where we are today, Michael Burry anticipates a further 50+% drop off in the stock market. It's a bold prediction, and it's a prediction that was once again met with criticism, as over the past few weeks, we saw the market bounce 6.5%. But as we've seen even just across the past few days, short-term bounces certainly don't mean we're out of the woods. And Michael Burry actually commented on this possible scenario. He recently tweeted, quote, "Dead cat bounces are the most epic. 12 out of the top 20 NASDAQ one-day rallies happened during the 78% drop from the 2000s top. 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top. Again, that's a lot of numbers to wrap your head around, but what he's alluding to here is that even during the worst times, the statistics show that it's actually quite common to see strong short-term recoveries amongst the longer-term downward trend. 12 of the top 20 NASDAQ bounces happened along this slope. 9 of the top 20 S&P 500 bounces happened along this slope. On the 5th of May, he added, quote, after 2000, the NASDAQ had 16 bear market rallies over 10%, averaging 22.7%, before bottoming down 78%. After 1929, the Dow had 10 bear market rallies over 10%, averaging 22.8%, before bottoming down 89%. So Burry certainly seems confident that we're simply in the early stages of a much bigger problem. And to further his point, he also took the time to comment on the comparatively low trading volumes we've seen during the 2022 downturn thus far. He said, top to bottom, Microsoft traded 5.2 times its shares outstanding by 2002, 3.3 times by 2009, and 0.5 times so far. Amazon traded 5.7 times by 2002, 6.6 times by 2009, and 0.9 times so far. JP Morgan traded 3 times by 2002, 5.9 times by 2009, and about 0.7 times so far, etc. Enough takes time. So really, when you look at the trading volumes, even though we've seen the market cool down, quite a bit in 2022, and everyone seems bearish from what you hear, the selling really hasn't even started. Have a look at this chart. As you can see, withdrawals from the market haven't even really started yet. Money is still flowing into the markets. So in Burry's eyes, we're likely going to see a lot more selling volume coming over the next few years, which would lead to much larger declines in the stock market. And it's a scenario that he said he's not looking forward to facing. On the 24th of May, he tweeted, as I said about 2008, it's like watching a plane crash. It hurts, it's not fun, and I'm not smiling. And that's the interesting thing to remember with Michael Burry is he's seen this happen all before. The first time through the dot-com bubble, the second time in 2008. He's seen these repetitive patterns of human behavior time and time again. He's studied the greed and excess of the major booms and busts. And I think that's what gives him such confidence when he talks about these issues or when he tweets about them. He recently posted this chart to his Twitter, which I thought was quite eye-opening. In white, we see the 10-year S&P 500 run up to today. In the yellow, we see the run up to the dot-com bubble, and in green, the run up before the Great Depression. It's pretty scary how similar they are. And Michael Burry comments on this, saying, third time's a charm, gotta love human nature, nothing if not consistent. For him, he's seen this pattern of human behavior many times before and he understands where it leads. It was only 12 months back that he was tweeting that he saw the greatest speculative bubble of all time in all things by 2 orders of magnitude. Perhaps now, in his eyes, it's been pushed to its breaking point. But of course, this is all just the stock market. We have to remember the core reasoning behind Burry's point of view is, of course, the economy. Now, we already know Burry's thoughts on inflation, and yes, we are seeing the Fed raise interest rates to make borrowing harder for businesses, but we have to remember that interest rate rises also affect the fundamental building block of the economy, the consumer. In harsh inflationary environments that bring about large interest rate rises, unfortunately, consumers have less money to spend because more of their savings and income go to servicing their debts. This very frequently starts a negative spiral because less discretionary spending means less sales for the companies that we're invested in. So ideally, you want the consumer to be raking it in. However, recently, Burry's been hinting that consumers aren't doing too well right now. Quote, US personal savings fell to 2013 levels, the savings rate to 2008 levels, while revolving credit card debt grew at a record-setting pace back to pre-COVID peak despite all those trillions of cash dropped in their laps. Looming, a consumer recession and more earnings trouble. So Burry is quite clearly worried about the depletion of savings, not just because it's pushing everyday people to use more credit cards in an environment of rising interest rates, but also because lowering of savings equals less spending, which hurts the bottom line of these businesses that we're invested in. One anecdotal piece of evidence that Burry referred to recently was Amazon's Q1 results. As CNBC wrote, quote, revenue at Amazon increased 7% during the first quarter compared with 44% expansion in the year-ago period. It marks the slowest rate for any quarter since the dot-com bust in 2001, and the second straight period of single-digit growth. Burry responded by saying, quote, and so Amazon says to GDP, there's your weakening consumer. And to follow on from that point, Burry also posted this tweet comparing the US personal savings with GDP. As you can see, the savings are covering less and less of America's GDP, at a point where America's GDP is shrinking. So overall, in Burry's eyes, we have inflation, interest rate hikes, reduction in consumer savings, thus less discretionary spending, which ultimately leads to lower profitability of businesses and, what we've seen thus far, re-ratings on their stock. And in Burry's view, we are only in the first inning. It's a very interesting topic to explore. I'm certainly not going to put my hand up and say that I'm the guy that knows exactly which way we're headed next. But definitely, please let me know, what do you think of Michael Burry's thoughts? He's certainly extremely bearish, but I think he quite commonly is. Do you think he's on the money? Do you think he's missing the mark? I'd love to hear what you guys think. Drop a comment down below. Give the video a like if you found it interesting. Subscribe if you'd like to see more, always appreciated. But guys, that will do me for today. Thanks very much for watching, and I'll see you guys in the next video.